Ever heard the saying, saving money is like making money? Sounds good, right? But guess what? There's more to it. Imagine you're putting money aside for later. Well, the tricky part is, over time, prices go up and your money's worth less. Plus, taxes come knocking, making things even trickier. Once upon a time, money was like gold. But now it's more like paper, controlled by governments and economies. And here's the kicker. Playing it too safe might not be so smart. Now, here's the big question. Could your safe savings actually make you lose money? You got it. The answer is yes. Starting to see why savers are losers makes sense? Let's dig in and figure out why keeping money in the bank might not be your best bet. If this interests you, don't forget to hit that like button and subscribe for more eye-opening insights on managing your money wisely. Number 1. Inflation quietly diminishes your savings. Imagine you're meticulously depositing your earnings into your trusted savings account, nurturing the vision of a secure financial future. But here's the catch. Under the surface, your diligent efforts might not be generating the financial growth you assume. Introducing the stealthy culprit, inflation. Here's a simplified breakdown. Your savings might be earning you a modest interest, say around 1%. Sounds good, right? However, lurking in the shadows is inflation, marching at a brisk 2%. What does this mean? While your savings seem to be gradually growing at 1%, the insidious effects of inflation are slowly gnawing away at their value by 2%. In essence, you're not saving as much as you think. You're unintentionally losing. And those seemingly innocuous bank fees, they're like quiet leeches, subtly siphoning off portions of your hard-earned money. Now, whether your money is parked in a traditional bank or tucked away under your mattress, it remains equally susceptible to the claws of inflation. Why? Because in today's financial landscape, money is no longer anchored to the preciousness of gold. It's simply a representation of value, vulnerable to the subtle erosions of inflation, regardless of its physical abode. Number 2. Any interest earned in savings is taxed at a high rate. Now, let's turn our attention to the world of interest-bearing savings accounts. The notion of earning interest might initially sound like a delightful melody, but let's explore the added twist. Here comes the taxman, even into the seemingly serene realm of savings. Let's break it down. Your tax responsibility is influenced by your income level and the tax bracket that corresponds to it. To illustrate, let's say you find yourself in the 22% tax bracket. Now, imagine you've successfully earned $1,000 in interest from your savings. A noteworthy accomplishment, right? However, this is where the plot takes a turn. Brace yourself for the sting. The government asserts its claim, a substantial $220. It's akin to receiving an applause followed by an unexpected pinch. But wait, the tale takes on an evolving twist. These taxes don't remain static, they accumulate, much like a snowball gaining momentum as it rolls downhill. The more interest you earn, the larger the chunk that's taken by taxes. It's a financial dance where savers find themselves in a paradoxical choreography, waltzing to the rhythm of losing rather than gaining. Imagine the scenario, your hard-earned interest slowly building up in your savings account, only to see a portion chipped away by taxes. With time, this dance between earnings and taxation can become a less harmonious duet and more of an uneven tug-of-war. If you're enjoying this, give us a thumbs up and hit subscribe. Stay tuned for more empowering insights to level up your financial game. Your support keeps us going strong. Now, let's move on to the next factor. Number 3. Strategic investments. Now, let's embark on a journey to a brighter horizon, the expansive realm of investments. This isn't just about shuffling money around, it's about embracing a comprehensive strategy that shields your financial future from the erosive grasp of inflation and the eager reach of taxes. But what exactly are these investments? Think of them as diligent workhorses in your financial stable. These assets don't sit idle. They actively contribute to your financial well-being. Picture stocks, bonds, the magnetic appeal of precious metals, and even the uncharted territories of entrepreneurship. Don't forget the captivating allure of real estate, an asset class that can yield dividends, generate passive income, and even appreciate in value over time. Unlike the stationary nature of savings accounts, these assets possess the potential to evolve, grow, and enrich your financial landscape. Let's dive into the 4 most lucrative assets that hold the keys to your financial prosperity. Number 1. Paper assets. These include stocks, bonds, and mutual funds, the heartbeat of the financial markets. When you invest in stocks, you're essentially becoming a partial owner in a company, riding the waves of its success. Bonds, on the other hand, involve lending money to entities in exchange for interest payments. Mutual funds pool resources from various investors to create diversified portfolios, spreading risk and maximizing potential gains. Number 2. Commodities. These are tangible resources like gold, silver, crude oil, natural gas, and even agricultural products like corn. These commodities have inherent value and can act as a fortress against market volatility. They're like a safeguard against economic uncertainties, standing strong even when financial markets waver. Number 3. Business ventures. Ever watch the excitement of Shark Tank? Business investments let you step into the world of entrepreneurship, where your financial acumen can help shape the future. You're not just a spectator, you're a player in the game, contributing to growth and reaping rewards. Number 4. Real estate. This is the embodiment of tangible investment, owning property. Real estate offers the potential for steady rental income, capital gains upon selling, and even acts as a hedge against inflation. As inflation nudges rents and property values upward, your financial stronghold remains intact. But what truly adds charm to this pivot is the notion of collaboration. You're not traversing this intricate financial terrain alone. A team of market experts, seasoned investors, and financial advisors stands by your side, guiding you through the labyrinth of possibilities. They assist you in crafting a tailored strategy that aligns with your aspirations and risk tolerance. Before you leap to the conclusion that this paradigm shift means abandoning the concept of saving altogether, let's introduce a nuanced perspective: the exceptions and strategic approaches. There are moments when saving is indeed prudent, a calculated act of financial wisdom. Consider earmarking funds for impending expenses, taxes, insurance, premiums, those well-deserved getaways, or the curveballs that life occasionally throws at you. In these instances, saving becomes not a liability but a tool in your financial arsenal. However, let's examine the distinction. When you channel all your resources into a passive savings account, that's when the narrative takes a turn. It's akin to depositing your dreams in a dormant vault, locked away from the vibrancy of growth. That's where the currents of inflation and taxes tend to erode your prospects. So, if you're seeking an anchorage for these short-term aspirations, consider the potential of online savings accounts. These digital havens often dangle higher interest rates, a result of their streamlined operational model. Some even flaunt alluring rates of up to 2.25%. Yet, a word of caution, ensure the online bank is FDIC insured and doesn't hold the threat of substantial withdrawal penalties. It's a strategic approach that ensures your funds aren't sitting idle but are working for you. There you have it. We've uncovered why being a saver might not fit today's economy, exploring 3 crucial factors. But wait, we're curious. Share your thoughts. How do you view savers in today's economy? Questions or stories? Let's talk. Ready to embark on a new financial journey? Hit the like button and subscribe for more insights. Your support drives us forward. Remember, evolving from a saver to an investor can shape a brighter financial future. Are you up for the change? Keep learning, keep growing. See you next time.